Hello and welcome to CMC Markets on Tuesday the 18th of March and the weekly market update. Now there's a number of key themes that I want to look at this week. Obviously Russia and the Ukraine and Crimea is one of them, and with that in mind I'm going to look at a comparison between the DAX and the S&P 500. I'm also going to look at this week's FOMC meeting, the potential ramifications of that. The UK Budget here in the UK, which is due on Wednesday. Quite a busy day on Wednesday actually. We've got the FOMC meeting, we've got the UK Budget, we've got UK unemployment, and we've got the Bank of England minutes. And I'll also be looking at US 10-year treasuries, those charts, the 10-year chart there. Have a quick look at euro dollar and also have a quick look at cable and the key levels on those particular charts. Okay, so let's start with the DAX and the S&P 500. Now over the past few weeks we've seen a significant decline in the DAX, and it hasn't really been mirrored by a similar down move in the S&P 500. Now if we look at this comparison chart of the two, up until the beginning of this year they actually correlated with each other extremely well. However, since the beginning of the year, while the S&P has continued to do fairly well, the DAX in complete contrast has fallen very, very sharply. Now, one or two things can happen as a result of this. Either the S&P 500 can actually start to catch up with the DAX, or the DAX can do a sharp rebound and look to actually recover back the levels that it's lost so far this year. Now, what are the risks with respect to the current stock market rally that we've seen, or the stock market rebound? I hesitate to use the word rally. Let's talk about the rebound, because we have seen a significant decline over the past few weeks. The DAX has fallen over 5%. The S&P, in contrast, hasn't. And I think that for me is the real head scratcher for me. Which of these charts, either the DAX and the S&P, is the leading indicator? So let's look at some of the key factors that are going to drive a move in either the DAX or the S&P. For me, it's about earnings expectations, and there are a number of key drags to earnings expectations going forward. There's obviously the situation in Crimea. There's the potential that Mr. Putin's actions may not match his words. He stated today that he has no interest in basically pushing further into the Ukraine. As far as he's concerned, the annexation of Crimea is pretty much where he is seeking to draw the line. However, Russian troop movements on the Ukrainian border do rather give mixed signals in that regard. Today we saw the German ZEW in this investor sentiment survey drop by a much larger margin than expected. It dropped from 55.7 to 46.6, which suggests that German investors are starting to become increasingly nervous about earnings expectations. You've got a slowdown in China. You've got higher interest rates in emerging markets. None of these are good for future earnings expectations. So for me, I think the bias remains, towards the downside in the DAX, and maybe there's a good chance that as long as we don't take out the highs around about 1885 in the S&P 500, we are well overdue a correction in that particular index. So let's look at now the US 10-year Treasury price. That's been in an uptrend since we saw the lows at the beginning of this year. As we can see from this chart, we can see the trend line support. It comes in around about 125.30, and we've seen yields continue to remain under pressure despite the fact that there is a high expectation that we will see a further tapering of asset purchases at the meeting this week, and this will be Janet Yellen's first press conference as Fed chair. So I think there'll be particular scrutiny on, first and foremost, of what she says with respect to guidance thresholds. She'll also be, I think there'll also be an awful lot of detail or scrutiny on the Fed's growth forecasts going forward and the guidance thresholds for the Fed funds rate into 2015 and 2016. But I think it's quite likely that we'll see a further tapering of $10 billion. Looking at where yields are now, there's a great window of opportunity. There is a certain expectation that I think yields will continue to fall, because I certainly think geopolitical concerns will continue to make US Treasuries a fairly safe haven for some of the slowdown and the geopolitical risk that we're seeing in emerging markets. Okay, so third chart, let's look at euro dollar. We've been in an uptrend for quite some time since we saw the lows in early February. We're above the previous peaks, around about 138. We've made highs of just below 140, around about 139.70. 140 is acting as a bit of a barrier at the moment, but the overall direction of travel, irrespective of expectations of further Fed tapering, is for further dollar weakness and further euro strength. And I think that's simply because, despite what Mr. Draghi said yesterday about the strength of the euro being a concern with respect to monetary policy, the European Central Bank still remains some way away from a further easing of monetary policy. The barriers or the hurdles for a further easing, I think, still remain fairly high. If you look at the CPI numbers, they're pretty broadly unchanged from last month's, and the economic data does continue to appear to be improving. The only concern remains France and Italy. But I think that data, even there, is starting to find a little bit of a base. So at the moment, as long as we hold above 138.10, 138.20, as indicated by the horizontal line on the charts, then I think a move through 140 is probably the higher risk, as long as we stay above that trend line from the lows that we saw in February. So let's finish off with cable. Cable has proved to be very resilient in the past 9 to 10 months. If we can look at the trend line that I've drawn on this chart from the 148.15 lows in the middle of last year, it's been pretty much one-way traffic. We are starting to run into a bit of a barrier around about 168.20 and above that around about 170, but I think as long as we hold above 165.40.50, as indicated by the lines that I've drawn on the chart in front of you, then I think upside momentum is likely to remain in place. Again, for the very same reasons that I outlined with respect to euro dollar. Simply put, the Federal Reserve is still in easing mode, albeit at a much slower pace. The Bank of England is not likely to ease any further. We've got unemployment this week that's likely to remain at 7.2%. Average earnings is starting to edge higher towards inflation. The economic data in the UK is broadly fairly positive, and that should be broadly constructive for the pound, as long as we don't fall below 165.40. Otherwise, there is a risk we can fall down to around about 163. Okay, so that's pretty much it for this week's weekly market update. Once again, thanks very much for listening. This is Michael Hewson talking to you from CMC Markets.